Number 9, dividend yield. This metric is generally relevant for large blue chip companies such as those constituting the Dow Jones Industrial Average. It is less relevant for small and high growth companies because these companies hardly declare any dividends. Some investors, depending on their risk profile and investment goals, will prefer large companies churning dividends consistently. Number 10, relative price strength. This metric compares last year price performance of stocks within a congruent group. Similar comparison between stock siblings is made for earnings per share. This type of analysis is typically done by Investors Business Daily, for example. Number 11, return on equity. It is an important metric which explains how much money the company is making at the behest of the shareholders' equity. In simple terms, it elucidates whether the company is efficiently utilizing resources at its disposal and is making profit. This metric is particularly relevant for growth investors. Growth companies should keep track of return on equity to ensure that the growth projects are generating positive net present value (NPV). The ROE metric clearly speaks of the depth and competency of the management. Number 12, insider ownership. It is generally argued that the larger size of the insider ownership is a better indicator of the success of a company. This proposition makes sense because when owners are stakeholders, they would work hard to push the company to success. However, this metric standalone cannot indicate the strength of a company. There should be periods when stakeholders would sell stocks to generate money from their changing personal and business needs. Number 13, forecast on company's performance. Value of a company is not based on its past performance. This is because past performance is only relevant to the extent that it can help analysts make some predictions about future trends and growth. However, there is no guarantee that the external environment would stay the same and that the company would repeat its past spectacular performance. Equally difficult is the forecast predictions about the future earnings and revenues of the companies. Investors should complete their own due diligence to analyze the possibility of meeting actual earnings and revenue goals. Number 4, integrity and depth of management. This is perhaps the most important metric to make an assessment about the future performance and direction of any company. Performance is a relative term and will vary depending on the nature of company. For example, from the viewpoint of growth companies, performance is defined by year-over-year growth while maintaining positive return on equity. For technology companies, performance is underpinned by successful launch of innovation in the guise of new product introductions. The caveat is that innovation is difficult to measure because of its rolling into both tangible and intangible domains. How can you, for example, measure the success or long term value of Apple iPhones? The ubiquitous existence of disruptive technologies makes this task even harder. Overall, the depth management and maturity of management is the most important metric to judge the future performance of a company. Number 15, volatility of stocks. This metric is absolutely critical in making decisions about the risk return profile of the investor. Put simply, volatility is a measure of how much returns deviate from the average value in a given period of time. Greater volatility implies greater risk. Volatility tends to be higher in the short run and would smooth out to some extent in the long run. For, of course, volatility depends on the correlation of stock prices to market swings called as beta. To conclude this lecture, the above framework must be analyzed in a holistic manner. Again, these metrics, when combined together, will be viewed differently by the value and growth investors. The value investor would be focused on the long-term competitive advantage, reputation of brand, and relative current valuation of the company. On the other hand, the growth investor will care about past and future growth patterns, regardless of 52-week price fluctuations and growth potential revenue generation of the company.